What are the four C's of mortgage lending and why should you care? When you apply for a mortgage, lenders aren't just looking at the house, they're looking at you. They're using the four C's: credit, capacity, capital, and collateral to decide if you qualify, what interest rate you're going to get, and ultimately how much you're going to pay every single month. Number one is credit. What is it? That's your financial reputation, your score, and your history of paying bills on time. Why it matters to you? A higher score can literally save you tens of thousands of dollars over the life of the loan. For example, a borrower with a FICO score of 740 or above often gets a lower interest rate than someone at 670. Here's a tip: pay on time, keep balances low, and check your reports for errors. Number two, capacity. What is that? Your ability to repay measured by your debt to income ratio. That's DTI, job stability and income, why it matters to you. The CFPB sets 43% DTI as the benchmark for most mortgages. If your DTI is higher, you may still qualify, but your rate will likely be higher and you'll need extra documentation. Here's a tip: pay down debt before applying. That makes you a stronger borrower. Number three, capital. What's that? That's the money you bring to the table, your down payment and your reserves. And why it matters to you: more capital means less risk for the lender, no PMI if you put down 20%, and better odds of approval. Fannie Mae requires proof of reserves, sometimes a few months of mortgage payments in savings. That includes 401k accounts, etc. Now, here's a tip: the bigger your cushion, the better your negotiating power. Number four, collateral. What's that? The home itself. Lenders require an appraisal to make sure that the house is worth what you're paying. Why it matters to you: if the property doesn't appraise, your loan amount could shrink or the deal could fall apart altogether. HUD and FHA also require homes to meet safety and structural standards. Tip: choose properties in stable markets that hold their value. Now, why should you care? The four C's aren't just banker jargon. They're the difference between getting approved or denied, paying a 6% rate or a 7% rate, owing hundreds more every single month, or keeping that money in your pocket. Bottom line, four C's: build credit, lower debt, save more, and choose wisely, and you'll save money, stress, and maybe even land a home you thought was out of reach. Which of the four C's do you think trip up buyers the most? Credit, capacity, capital, or collateral? Drop your guess in the comments, tag a friend who's house hunting, and follow for more tips that could save you big when it comes time to buy.